Hello and welcome to the Resilient Investor. This is a program designed to help beginner investors, probably mostly a bit younger than average, to become more resilient in markets, stock markets. Because it's pretty volatile time out there at the moment, and it's pretty easy to lose hope when you're investing in shares and bonds, all that kind of stuff. So this program is designed to talk you through how markets work, to help maybe develop better strategies for building a portfolio for the long term. So my name is David Stevenson, and I've been around in investing for an awfully long time. I've got quite a few grey hairs. Lucky it's not on video. And I write for the Financial Times. I've been writing for them 15 years. I write for Citywire, for Money Week, in the past, Investors Chronicle, and also helped found a couple of fantastic websites called AltFi and ETF Stream. And with me is Sam Ridley, who is much better looking than I am, far younger than I am, although he has a few more grey hairs than I am. So, Sam, what's your background?
Hello all. By day, as David said, I am AltFi and ETF Stream Managing Director and work closely with David. By night, I'm a budding stock market investor, making lots of mistakes that I'm sure you'll all be learning from during this series. And I'm sure that's why David has me on the podcast to talk you through those wild mistakes. But hopefully I will learn from them and, see the green rather than the red.
Oh, I'm sure you will. And Sam, you undersell yourself. You've had some very good investments in the past. And let's be brutally honest. Mind you, I can only count about one. But let's be honest, everybody's suffering horribly at the moment. So you're not unique. So let me go you through the format of the program. All right. So each program, roughly about 20, 35 minutes long, somewhere in that range. We're going to talk about one big subject. I'm going to try and sort of educate Sam into sort of one big idea. And we're going to talk a bit about diversification. We're also going to raise one topic that Sam's going to raise every time, something that he doesn't quite understand or wants to get his head around. There's lots of confusing jargon in investing, lots of ratios.
How to pick a winner.
How to pick a winner, yeah. Lots of acronyms that no one's got the blindest idea what they really mean. So he's going to try to ask one kind of question. And we're each going to try and bring one idea on a regular basis. I've got an idea which I'm going to bring at the end of the program for something you can positively go out and do. And this is all about psychedelic investing, not investing on drugs, but investing in companies that make psychedelic drugs. And I promise there's no mini dosing involved. I'm
David,
not going to
sorry, just to interrupt so early on, mini dosing. I thought we knew microdosing, unless this is a new form of microdosing.
Yeah, it's one way you do it with shares instead.
Right.
Right. Anyway, yes. Anyway, I'm not microdosing. Actually, this is a reasonably good investment idea, though I have to say, incredibly unpopular at the moment. Anyway, so I'm going to start off with the big statistic, which is roughly 32%. Now, 32% is the average decline. Although depending on the time frame you use, it can be 35, 33, but roughly 32, or in a range between 30 and 35, is the average peak to trough decline in a bear market for American stocks. Now, as I said, that range varies because it depends on what timescale you use. Last 50 years, 40 years, last 100 years, the numbers slightly change. So if you go over 100, and I think if you go over 130 years, the number's a bit bigger because, of course, it includes some really big falls way back before the Second World War. Anyway, if you look after the Second World War, that's the big average decline. It's between 30 and 35%, and we're in the bear market. Bingo. So I haven't looked at the markets recently, but if I was to look at the S&P 500 on my screen at the moment, which is the big American market, the index, year to date, so that's since the beginning of January this year, it's down only 20.6% since the 2nd of January. So, which is a pretty painful thing, but that hides a wide variation, which is lots of other stocks have gone down even more, particularly tech stocks. Yeah, go on.
Yes, I was going to say, David, from my perspective, hearing the numbers of 32% average bear market or even 20% S&P year to date are somewhat quite adrift from the percentages I'm used to seeing in my portfolio, with the majority of my stock selections that were made 2020 we're looking at 60 to 70% down, some stocks 80% down, and that's a recurring theme through a couple of my portfolio ISAs. So yeah, as much as the kind of 32% bear market is a big number, I suspect there are many investors like myself who are used to seeing the 60, 70, 80% individual stock percentage down, particularly on kind of 52-week highs, very low. I can only wish that I was 32% as a figure across my portfolio. So
so a good example about exactly just bringing up in that point. So looking at what I've got in my portfolio, for instance, so I've got some tech stocks. So they were down pretty badly. So a good example is Spotify. Yeah, great company in my book. I love them. You know, down year to date, a mere 59.9%. But it's not just tech stocks actually. Interestingly enough, Walt Disney.
Yes.
So it's got a tech angle because it's got the streaming business. Yeah, it's a Disney Plus. But it's got lots of other stuff as well. You know, it's like cruise ships and like theme parks and a very small film studio that does a few small films that no one's ever heard of to do with Marvel, or I think it's Marvel.
Yeah, well, David, I wonder. I wonder with this, David, though, when you mentioned Spotify being down. When I look at a lot of the companies that I have within my portfolio that are down 70%, I mean, as well, Netflix being a prime example, down to a stock price beyond 5 years ago, even before the COVID dip.
Yeah.
These businesses are still performing well. A lot of them are cash flow free and in positive territory. They're making profit. They're growing. Is this such sharp decline and such a huge decline a combination of factors? Is it a due recession? Is it inflation rise? Is it stimulation from COVID over the last 2 years has inflated valuations beyond wildest dreams and PE firms did very well? Why are these price drops so dramatic to bringing share prices back before, the COVID period where you could maybe assume that that's why they were so high? This is 4 or 5 years ago that they were resuming values.
Absolutely. So let me just finish with the Walt Disney point. Walt Disney, astonishingly, is down 39% year to date. So that's a pretty big fall. Yeah,
it is. Huge.
But even Microsoft, which is about as boring as you can get, it's a tech stock still, and it's down 23%. So so what's going on here? So what I'm trying to simply say is there's a variation. In there's Microsoft down 23%, oil companies probably up. Walt Disney down 40%, Spotify down 60%, lots of stocks, really go small cap stocks down 70, 80%, as you say. So what's going on here? I think that there's two things going on, one of which is there's increasing interest rates in America. And you might think, what's interest rates got to do with a tech stock, for instance, Spotify, And the reason it matters is because you might have heard this term growth versus value. And a lot of tech stocks are growth stocks. And traditionally, when interest rates go up, people think, oh, that's a bit worrying because we might be about to enter a recession or it could cause problems. Also, those growth companies won't carry on growing anymore. So what I'll do is I'll rotate. This is the word you hear, rotate. I'll sell my tech stocks. Absolutely. I'll sell my tech stocks and I'll move into slightly more boring stocks like banks. Banks do quite well with interest rates go up, for instance, because they make more money on loans and their margins go up. So there's a rotation thing going on with interest rates. So that is definitely a factor. But the other thing is that valuations. So what do we mean by valuations? Traditionally, people use these metrics. The classic ones are, if a company pays a dividend, you look at the dividend payout versus the total value of the company and you have a dividend yield. Or you have what they call the price to earnings ratio.
PE ratio.
And PE ratio. And what that it sounds complicated. It's not really. Let's assume you've got a company worth $100 million and it produces $10 million of earnings, profits. Then the PE ratio is 10. And then if you have a company that produces $10 million of earnings and it has a market capitalization of $500 million, then its P ratio is 50. And all that's really happened is that rotation before the rotation happened, those valuations got a bit high. And actually some of the companies weren't even making a profit. So, classic example, actually, I wanted to mention Walt Disney because Walt Disney is actually a very good example because it's a bit techie, but a bit non-techie.
The streaming service, correct?
And absolutely, yeah. And, so here's a classic example. Walt Disney, as we're talking, is trading at $94 per share. And looking at its earnings, because it does produce profits, lots of them. It's basically looking at for the full year ending 2022. Yeah, so that's this current year, financial year ending 2022. So it's a forecast. It's trading at 23.5 times its estimated earnings. Now, traditionally, in some eras, that was trading down at 18 to 20. Yeah, it does seem high. And so partly what's gone on here is that valuations got a bit out of whack and are beginning to come back in again. Another classic example is Microsoft, actually, because that's as boring as they get. And Microsoft, and here actually is a good example, Microsoft is trading at a forecast, so that's looking through to the end of 22, forecast P of 27.6. That's not cheap. Now, you might say, why am I saying it's not cheap? Because for most of the post-Second World War period, most American stocks tended to trade in the kind of 15 to 20 range, and then interest rates went very low, everything changed, and then stuff tended to trade in the 20 to 25 range, But then before COVID, and then actually immediately after COVID, once you had the crash, everything started trading at 30 times, 35 times. So one part of what's going on, it just got a bit out of kilter, and it's just come back in again.
And typically, is the trick for investors, and maybe the difference between a growth and value, is one investor will look for low PE to find the value in that business, and the other will accept that PEs will be higher to buy growth, hoping that returns are more explosive, and so it's a bit more of a gamble. And those growth investors are now just stuck in a rotation. For someone like myself who hasn't sold out of my positions, I know there's sometimes the 20% rule. I will hope there is a 70% rule because that's where I'm at right now. I haven't sold anything. In fact, I've been considering buying some more because I love the saying that both Bezos and Buffett have said in past periods, the company is not the stock. And so I think what they mean by that is, the company can still perform well and be growing through even turbulent times. It doesn't reflect the stock price. When you think back to Amazon, and this is a stat I always try and pick myself up on, .com bubble, they fell 90% in share price, and yet the business was growing. They were hiring, they were creating new products. And look at Amazon now, after all of its stock split, it's still hugely performing. So I wonder if those that believe in the fundamentals of the business you're in, which I have quite a few businesses within my portfolio that I do believe in, that are there for the future, this is a generational buying opportunity.
Yeah.
Would you agree with that, or do you think I'm optimistic?
In that typically non-committal, almost politician way, I'd say yes and no.
Brilliant answer, David. For all of the listeners out there, yes or no, yes and no.
No, pick whichever one you want. Okay, so yes, I agree with you, but so there are lots of quality businesses out there, even in the tech space. Actually, Microsoft is a perfect example. Microsoft has done a remarkable transformation. It's got all of us paying out money every month to it, as opposed to buying a shiny CD, which is sticking on a computer. And it's also built up its other businesses, like its games business, and that kind of stuff. So it's definitely a growing business, And therefore, you should be happy to carry on investing in that company with rather less concern about the stock. The problem is not every company is Amazon or is Microsoft, And everybody likes to think they are Amazon or Microsoft, but they're not. There's only a few, it's a winner-takes-all market, particularly tech. Very big companies scale very quickly, and there's only going to be one Amazon, or maybe two, I suppose. But, and then there's all the other companies that said they were going to be Amazon that aren't Amazon. We don't remember them because they all vanished.
David, there's a great book. It's just a good time to plug up a book I've recently read, trying to absorb much information as possible and learn from those that have done it or learned from previous cycles. There's a book called 100 Baggers by Christopher Mayer about, typically 1 in 10 of your portfolio will turn out to be a multi-bagger. It doesn't need to be 100, but it might be a 10, 20, 30. And I suspect what you're saying in relation terms to that, not every company, true to the book's form, is going to do an Amazon or a Microsoft where they have returned exponential numbers.
Absolutely.
And so that's something I'm I'm forever finding that unicorn, I suppose, with the basket I have at the moment.
And that is the problem, because it's quite difficult to find that unicorn, because and usually once it's become obvious that it is the 10 bagger to mix metaphor, then everybody else has piled in already, and the stock's already crazy. I think one of the best ways, I suppose, the advice I could give is look at what you spend your money on. Yeah. Okay. And if you spend a large amount of your money on something, and you will continue spending a large amount of your money on something even through a recession, then that is an interesting company, because that's a company that's globally scaled. You're aware of it as a brand, as a product. This is quite narrow to consumer products, so this doesn't include companies that sell to businesses. So in the olden days, before tech came along, people would, say classic stocks in this category are Unilever or Diageo, because you're always buying baked beans for Heinz, or you're always buying, with the classic brand names, you're always buying their products. Yeah?
Yes.
Now, I would put it to you that Microsoft probably does fall that category. Yeah.
Yep.
But I'd also put it to you, but it's already possibly in the price in Microsoft. Yeah. But I put it to you, to come back to a name I mentioned earlier, Spotify is arguably in that category. So Spotify share price down a mere 59%. It doesn't really produce. I mean, it is producing profits, but it's producing quite small profits because it's paying a lot of money into its podcast business.
Joe Rogan was a big name within that deal, wasn't it? Joe Rogan did a deal with Spotify to really improve their podcast platform.
Yeah. Yeah, and they are basically, I think they're making good progress. Yeah. Now, so here's a classic example. So I'm just looking at the numbers now. That most analysts expect Spotify in 2022, full year 2022, to make 11 billion turnover, moving up to 13.4 billion turnover in 23. But they probably expect it to lose money in 2022 because it's plowing all that money into what it's doing. Yeah. Now, I would argue that Spotify is interesting because it's not Microsoft. It's not producing vast amounts of profits, but it is effectively a product that all of us really, really, really use. Yeah. And
every day.
Maybe I'm a middle-aged bloke maybe I'm a middle-aged bloke, and maybe I do rely too much on my Spotify and I can afford it, but I wouldn't even think twice about cancelling my Spotify subscription. Yeah. I wouldn't think it. I wouldn't do it because I listen to loads of music and there's no other way of doing it and I like it. Now, it's got to work out a way of making more profits from that. That is a challenge for it. But I think that's a really interesting thing. Now, its shares have been absolutely pummeled, because everybody say, well, it's not making any profits, blah, 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 blah. You can fit in the rest. But I would say that if you're looking for a brand of tomorrow, then things like Spotify are the places you're looking at.
And it's encouraging to hear a business reinvesting, ploughing money back in to grow its platform, to grow its opportunities commercially. I think for someone like myself that's looking for, again, going back to that term, a potential multi-bagger, it could be 5 times. It doesn't always need to be the kind of 100 times that you read about. A business reinvesting is surely on the right path to that because they're looking to innovate and grow. It's encouraging you say that, actually. It wasn't on my watch list, but it certainly will be entering the watch list.
Okay, so I'm gonna. That's a nice segue because Spotify, is based in. Actually, originally it was Estonian, but in reality, most of us, it's listed on the US market. Most of us regard it as a US stock, although, as I said, it is actually an Estonian company by background. But that brings us back to the question of America and diversification. Yeah. So really, what I want to talk a bit about here is. It's really important that investors are diversified. What do we mean by diversified? Which means, classic, you don't just have 2 or 3 stocks, from just 2 or 3 sectors, maybe 1 or 2 sectors. You diversify across the piece. What do we mean by diversification in practical terms? We mean geography, which is more than just the US, and we mean sectors, more than just tech, and we mean styles, more than just growthy stuff.
You mean there's more than just tech out there, David?
Yeah, funny that, isn't it? Or there's more than just America out there. Do you want to hear a scary statistic? 68%, So if you were to buy the MSCI World Index, it's a huge index. It's got all the world's leading large cap companies in the developed world. Okay, 68% of the value of that is in US stocks. That's a scary, crazy large number. Yeah.
Yeah.
So when you
What would you
buy
expect
American,
that to be? Huge. I mean, what would you be more comfortable with that being if, you know?
I think look, your relatives American markets are the most liquid, easy to trade. Everybody's heard the names, all that kind of stuff. It's rather difficult to open up a Chinese retail broking account. So, well, I suppose you could always give it a go. I would be happier if it was in the kind of 50 to 60 range.
Okay.
Yeah, it's going to be big anyway. Yeah, but and it's certainly much that footprint's much bigger than America's GDP weight. So if you looked at the American economy and looked at it, it's much bigger than that. But I'd accept it's bigger than that. But the geographical diversification matters. So having some exposure to, say, Europe as well as America, maybe even emerging markets at some point, is really important. Also, having exposure to different sectors, not just be tech focused. So if I was to look at the MSCI World, 21.37% of that is in information technology. And actually another 7.5% is in what's called communication services, which is telecom companies, internet companies. So getting on for 29% of the total index is actually in just what you and I would understand as techie-orientated stuff. So I pretty much guarantee that most young investors are not 28% exposed to tech. I pretty much guarantee you they're probably more than 50%. Now, correct. I think that's probably a mistake because there are some good companies in other sectors, like banks, like or energy companies, like loads of stuff that you should be looking at. And the last thing is about style. Style matters. So don't just have crazy valued tech stocks. Yeah. Great. If you want to do your 10 baggers, fine. But also have a think about having different styles in their company. Yeah. Some boring companies in there. Yeah. Because some boring companies can provide some solace. So I'll give you an example about why you might want boring companies in there. Yeah. So here's a classic example. In Britain, there's a company called Melrose Industries. All right. Mm-hmm. In reality, it's what you and I would know as a company called GKN, one of Britain's biggest engineering companies. It's pretty damn boring. Yeah. And it's old world. It's a bit value orientated. It's very profitable. Yeah. I'm just looking at the numbers now. It's not ridiculously cheap. It's about 23 times forward earnings profits. So it's not massively cheap, but it's a boring company. It's what you call a cyclical, more value-orientated stock, not quite value as such. It's since the beginning of the year. I'd like to guess how much it's down by?
15 to 20?
-3.
Wow. So it's weathered the storm.
Yeah, absolutely. Yeah. Another example of something you might want to do, it's a bit more extreme, actually. So this is a way of making sure you diversify and what we call hedge. Yeah, hedge your risks. That means you have stuff that does well in bad markets. So I'll give you another example. There's a company called Plus 500. You may have heard of it. They do kind of spread betting. Yeah. Yeah. It's a Israeli company, but exactly. It's Israeli company, but I think they're listed in the UK. And if markets go crazy, upside and downside, they tend to do well because people think, I know how to game shares really well, so I'm going to spread bet on, I don't know, Spotify, Melrose. Care to guess what their share price has done since the beginning of the year, Sam?
Well, with the volatility, I would hope it's increased, maybe 10%.
Up 20.5%.
Double again! Wow.
So, the reason I'm running through all of these, just another small example. Shell, no surprise to know it's probably up. Yeah, it's up 34% since the beginning of the year. Yeah, and that's as boring as you can get in energy. Yeah. So what I'm simply trying to say is, I'm not saying that you should always have a portfolio full of Shell, or Plus 500 or Melrose. But what you might do is you might have some stocks that have those characteristics that those companies represent in your portfolio, and they provide some
diversify. Yeah, no, it makes a lot of sense.
Yeah, diversify.
If you were to highlight those numbers to me, I would certainly take them, and that's something I haven't done a good enough job of over the last few years, is diversifying. I think this is a good learning curve.
Have you got anything which is non-tech in your portfolio at all?
Yeah. So I've got
Says
Exxon
he's scrambling to find out what.
Yeah, no.
Oh, you've got Exxon. Okay, good. Okay.
I've got Exxon. I mean, airline can be bagged the same as tech businesses at the moment, to be honest, in terms of their performance. But I do have Wizz Air and have done. I've got some energy stocks, clean energy in the US, something I've held on to through the pain, I should say. Some automotive stocks. I've got GM, General Motors, and that's actually weathered fairly okay. I've got JP Morgan Bank. So,
I've been that you've got some,
got something, but nothing, and really they weren't bought at the beginning of my portfolio creation. They were done when things got choppier and I did more research. And funny, you mentioned invest where you spend your money. I spend a huge amount of money subscribing to investment newsletters to try and find the answer to my problems. So I don't know how I invest in that apart from, So I've got a few diverse businesses.
What would you say? Sorry, finger in the air. What would you say your percent value of your portfolio is in those boring stocks?
10%.
Yeah. Okay. Therein lies the problem. Yeah.
Yes. Yeah. I've picked good names, but I haven't put enough of my capital, and I'll tell you why. Because when I try and DCA, I do a bit every month.
What's that again?
Dollar cost average. Sorry.
So you put a little bit in every month.
Yeah, so I chip away. So the idea being, at the very beginning when I set up my portfolios, with the £20,000 tax allowance that you get within your ISA per annum in the UK, and that means that your returns or gains will be tax-free. Back in 2019, I did a lump sum deposit and really spread my portfolio value at one time. And then obviously it did well in 2020 when the markets and I was buying at ultimate lows. But since then, I've only been able to DCA and spend a little bit of my monthly salary diversifying. So that's, I think, where the disparity is between such large positions in the tech stocks, because I had more capital when I invested in these tech businesses than where I'm at now, which is each month I'm putting a portion of my salary to buy these diversification stocks, as I would call them. And maybe I should be selling some of my lost positions, but then that would be liquidating my losses and realizing them. And I hope that they will return one day. So I feel slightly caught in knowing what to do. But yeah.
Okay. All right. Well, we'll talk a bit about how in future episodes about how to deal with stop losses and how to manage your losses. So we'll come back to that in a future episode. I just want to finish in the last couple of minutes. We always want to finish on an investment idea. I'm going to kick off. Your turn next, Sam.
Yes.
So in the next episode, you're going to have to come up with the investment idea. But I'm going to come up with an investment idea which is a bit far out there, a bit way out there, a bit, how can I be, almost psychedelic. And it is psychedelic companies. Yeah. So these are boom, dum, dum. Yeah, exactly. I should hang on a second. Hang on. We've got some music here. We can basically do a kind of we could do a cheer. Yeah, they cheer twice there. Amazing, these buttons. We can keep pressing. We'll keep coming back to the clapping one. So psychedelic drugs. Companies you could look for include ATAI. I never know how to pronounce it. ATAI Life Sciences. Another company called Compass Pathways, which is actually a British company. There's another, I think it's a Canadian company called Cybin, Cybin. And I think, they talk about declines in share price. These guys have had their share price decline quite recently. So classic example is, I'm just looking at ATAI, which is one of the bigger ones. It's actually not down as much as I thought it would be, actually. It's only, since the beginning of the year, only down 52%. Although I would point out that the reason for that is because they were also falling in 2021 as well. So actually, if we were to, exactly. So if we were to look at the charts for it for the last few years, it's pretty much heading one way, which is down. Why do I think it's interesting? ATAI, I don't know how to pronounce it, and Compass, they're both interrelated actually, because ATAI owns a big shareholding in Compass. Psychedelic drugs are so we're talking about psilocybin here, LSD or variations of ketamine, all that kind of stuff. this is it got caught up in the cannabis craze. Yeah.
Yeah.
So cannabis went a bit bonkers a couple of years ago, and then basically fell out of bed and gone nowhere for the last year. It got caught up in that, but it's fundamentally very, very, very different. These companies are biotech companies. I'll give you the short version. Atai and Campus. Campus is a good example because we can relate to it here in the UK. A lot of its technology comes out of Imperial College in London, big research centre there, headed by Professor Nuttall. A lot of this stuff is biotech, it's pharmaceutical stuff, and effectively they're developing a whole series of drugs which are in varying stages of clinical trials. In fact, some of them quite late stage, dealing with mental health issues, depression, long-term depression, PTSD, and what they found is that these drugs do seem to be helping as a replacement just for endlessly taking, for instance, antidepressant drugs, and do seem to be helping with, for instance, a kind of psychological reset. There's been BBC did a fantastic documentary about it about a year ago on the Imperial College program. This stuff isn't shady, odd, weird, strange. This stuff is becoming mainstream, and we are probably no more than 2 or 3 years away now from the first products beginning to hit the market, and they're likely to come from people like Atai and Compass. And these are really interesting companies. If they've got enough cash to get them through to the point at which they can get their drugs out there, assuming they pass the clinical trials, then they suddenly become very attractive to the very big pharma companies who've been known to buy biotech companies. And crucially, both Atai and Compass have got enough cash. So Compass only trades a little bit above its net cash. I haven't got the figures in front of me, but the last thing I looked, I think it was in the hundreds of millions of dollars. So it's got enough money to get itself through to the point at which it can get its drugs on the market. And this is a classic kind of negative momentum sector. Everybody hates it at the moment, because they just think it's not going anywhere. There's real science happening here, very interesting science happening here. There's enough cash with the big guys to get them through to the product stage, product delivery stage. So I think if I was looking for something which I just hesitate to say might do very well here, not quite, I wouldn't go so as kind of your 10-bagger, but might do quite well. I would spend a bit of time watching the psychedelic drug companies.
Interesting. Okay, that's noted on my watch list. And do you know how long typically the approval stage for a business like Atai or Compass to get their products trialed, approved, and then to the market?
Yeah, quite a long time. Yeah, many years basically. It depends. Yeah.
Okay.
So sometimes it can be as long as 5-6 years because they, the regulators sort of throw back the application and they have to redo bits of it. Sometimes it can be very quick. The quickest you can see is the vaccines of COVID. A lot of that stuff literally came through in weeks. Well, not quite weeks, maybe months. Years, 2 to 3 years. I think where these companies are at the moment, I would expect to see a viable pipeline of products in 2 to 3 years.
Okay.
So, but I don't want to fool anybody. Their shares could go even lower.
I was going to ask, recession looming, or if it is or isn't, or stock price hurt to continue. These are businesses that can still be affected.
No, I don't think they're going to be set recession so much. I think the problem is they sort of sit within the wider biotech sector, and biotech has had an absolute mauling in the last year. And it's quite possible that more and more people will just close their positions in biotech because it's just been so horrible for them. They could just get caught in this kind of, there's almost a term called negative momentum. You might have heard of positive momentum. Meme stocks, everybody gets excited about stuff. Everybody rushes in. I must have it before I miss out.
FOMO.
And the share price keeps going over higher. Yeah, absolutely. Fear of missing out. Well, what's the opposite of FOMO? Yeah, it's called negative momentum, which is, Jesus Christ, it's a disaster. I hate it all. I'm just lost will to live. I'm just going to get rid of this stuff. It's disastrous. And I just don't care any longer. I'm just going to go sell my biotech stocks and invest in Exxon. Yeah.
I'm going to go and sell my biotech stocks and buy some psychedelic drugs.
Yeah, exactly. Yeah. So you could have negative momentum. So they're trapped in a negative momentum cycle. They could go lower. But I think they're worth watching.
Okay. Added to the watch list. Ping. I will bring my idea next week.
Yeah, so you've got pressures on you, Sam, to bring it to the next program to bring your idea. And in the meantime, simple message, 2 messages: diversify. Yeah, diversify. And bear in mind that most bear markets tend to have a fall of somewhere between 30 and 35%. and they tend to last about 9 months. Yeah.
Right.
And the market started declining in January, so we're 6 months in.
So
I'll
Q4
let you
could be
fill
a
in the
positive
gaps.
quarter for businesses. And doesn't that tie in with the last cycle of the presidential cycle, which I've been doing some reading about in the US as well, which tends to be when markets pick up a little bit. So I'm hoping for a positive Q4. So everyone out there in the same pain boat as I am.
Yeah, carry on hoping. Right, on that joyous upbeat message, until the next episode.
Ciao,
See ya.
ciao.